Barry Westergam, stay beside the training desk.
The classroom makes this look cleaner than the market ever was.
There are two versions of Barry Westergam. The licensed appraiser his clients trusted to give them an honest number, and the man named in a federal indictment for doing exactly the opposite. Both are the same person, and both are about to be exposed.
The case centered on appraisals above actual purchase prices.
Everyone wanted clean numbers after messy deals. That was the whole boom.
You were supposed to be the independent check.
Independent sounds simple on a whiteboard, not in a market where everyone was chasing the next close.
He would not get the chance to explain it away. Within 48 hours, federal agents would be carrying boxes of appraisal files out of an office on Beach Boulevard, and a federal grand jury in the Middle District of Florida would be reading the closing statement from a single Jacksonville house. One property, two prices, $135,000 vanishing through a line item called assignment of contract fee. 55 properties, $29 million in mortgage loans. One licensed appraiser who served as both the buyer's agent and the independent valuation on every single deal. Quick question before we go on. When you bought your house, or the last time you watched someone close on one, did you ever stop to think about who actually decides what that house is worth? Drop your answer in the comments, and subscribe if you haven't yet. We cover white-collar accountability cases every week. And this one is the textbook example of why that signature on an appraisal is supposed to mean something. Barry C. Westergam was born in 1949, the kind of post-war American kid who grew up watching his father read the real estate listings in the Sunday paper. His family settled in Florida during the Eisenhower years, when the state was still mostly orange groves and two-lane roads, and Jacksonville was still defined by the Navy Yards and the paper mills on the river. His father worked in commercial lending. His mother kept the books for a small construction outfit that built ranch-style starter homes for returning sailors. Property was the family language. Square footage, lot lines, comparable sales. These were dinner table conversations before Barry was old enough to understand them. He graduated from Robert E. Lee High School in 1967. He spent 2 years at Florida State College at Jacksonville, then transferred to the University of Florida in Gainesville to finish a bachelor's degree in finance in 1971. He came back to Jacksonville with a degree, a fiancée, and a job lined up at a small mortgage brokerage on Hendricks Avenue. Within 4 years, he had moved into residential appraisal full-time. By 1978, he had passed the certification exams and held his own license. By the early 1980s, he had hung his own shingle. Jack's Appraisals, Inc., opened on Beach Boulevard in 1984. It was a one-man shop at first, then 2, then 4 employees by the end of that decade. Westergam built the business the way you built any small professional practice in North Florida in those years. Rotary Club lunches, sponsorships of the Boley School baseball program, a quarter-page ad in the Jacksonville Business Journal, and a reputation for turning files around faster than the competition. He married a woman named Linda in 1976. They bought a 4-bedroom on a corner lot in San Marco in 1981, raised 2 children there, sent them both through Episcopal School of Jacksonville and on to in-state colleges. Linda taught 3rd grade. Barry coached the Mandarin Athletic Association youth baseball team 3 seasons running in the late 80s. His daughter would later describe him in a sentencing memorandum letter as a man who left for the office at 6:30 every morning with a thermos of coffee and a stack of file folders, and came back at 7 every night to grill on the patio. In 2003, with the Florida housing market beginning to climb steeply, Westergam did something that most appraisers in his peer group considered a conflict of interest red line. He opened a second business. Property Associates was registered as a Florida real estate brokerage out of the same Beach Boulevard suite. He held the broker's license himself. Jack's Appraisals would continue to do residential valuations. Property Associates would represent buyers in residential transactions. 2 corporations, 2 licenses. 1 man at the top of both organizational charts. 1 physical office, with 1 shared receptionist and 1 filing system. He was, by every account from former employees, meticulous about keeping the 2 businesses on separate letterhead, separate bank accounts, separate phone lines, separate email signatures. The wall between them, on paper, was complete. In practice, it was a fiction. And during the boom years that followed, that fiction would become extraordinarily lucrative. To understand what Westergom did, you have to understand what an appraiser is supposed to be. When a buyer applies for a mortgage to purchase a home, the lender does not simply hand over the requested amount of money. The lender needs an independent verification that the house is actually worth what the buyer says it is worth. That verification is the residential real estate appraisal. The appraiser is hired through the lender's process, paid a flat fee, and is supposed to function as an impartial third party. The appraiser visits the property, measures the rooms, photographs the exterior, the kitchen, the bathrooms, the mechanical systems, pulls 3 to 6 recent comparable sales from the same neighborhood, adjusts for square footage, lot size, garage spaces, pool, condition, writes a report, signs and dates it, submits it to the lender. That signature is a sworn certification. The appraiser is attesting under federal regulation that the comparables are reasonable, the methodology is sound, and the value figure represents an honest opinion of market value. The whole mortgage system is built on the assumption that this signature means something. Lenders rely on it. Federal regulators rely on it. The borrower relies on it. So does every neighbor whose own home value will be measured against that comparable in the next deal 3 months later. Florida, in 2004 and 2005 and 2006, was where this system broke down the hardest. The state was adding nearly 1,000 new residents a day. Median home prices in Duval County were climbing roughly 2% per month. Speculators were buying houses sight unseen on the assumption they could flip them to the next buyer within 90 days at a markup. Lenders were rolling out stated income loans, no documentation loans, second mortgages stacked on top of second mortgages. The volume was overwhelming. The internal review at most banks had been outsourced or automated. The appraiser, at the front of that pipeline, was often the last and only human checkpoint between an inflated price and a federally insured loan. Westergom knew this. He had been licensed for nearly 30 years by the time the boom peaked. He had watched the system tighten in the early 90s after the savings and loan collapse. He had seen the uniform standards of professional appraisal practice rewritten twice in his career to address exactly the kind of conflict he had now built into his own daily operation. He knew that holding both the appraisal license and the buyer's brokerage license on the same transaction was not, in itself, illegal in Florida. He also knew it created an opportunity that an independent appraiser could never access. And he knew which lenders in town did not look closely at the licensee names on the closing statement. The arrangement with Juan Carlos Gonzalez began sometime in 2005. Gonzalez was a Florida resident in his late 30s who operated a small Jacksonville real estate investment company. He represented himself, in conversations with sellers and lenders, as a buyer of mid-tier residential properties. Houses in the $400,000 to $700,000 range, in established neighborhoods like Mandarin and Ortega and Beauclerc. He told sellers he was acquiring inventory for a rental portfolio. He told lenders he was a high net worth individual diversifying into Florida real estate. Neither story was fully true. The mechanics of the scheme were almost elegant in their simplicity. Gonzalez would identify a property listed for sale. He would negotiate directly with the seller, often through Westergom, acting as his buyer's agent under the Property Associates banner. The two of them would agree on an honest, market-rate purchase price with the seller. Call it $490,000 on a particular house in Southside Jacksonville in early 2006. That figure went on to the real purchase contract. Then the second piece moved into place. Gonzalez applied for mortgage financing through a lender. On the loan application, the purchase price was listed not as the actual negotiated number, but as a higher figure. $625,000 on the same Southside house. Westergom, wearing his Jack's Appraisals hat now, would conduct the appraisal on behalf of the lender. He used the wrong comparables. He cherry-picked nearby sales that had spiked during the boom. He ignored more accurate comparables that would have brought the number back down. He padded square footage adjustments. He wrote up the file. He signed it. He submitted it to the lender at exactly the inflated figure that matched what Gonzalez had reported as the purchase price. The lender saw two documents lining up perfectly: a purchase contract for $625,000, an independent appraisal for $625,000. The math worked. The loan was approved. In many cases, Gonzalez applied for both a first and a second mortgage stacked on top of each other, drawing nearly the full inflated value out of the lender in two transactions at the same closing. What happened at the closing table was where the money actually moved. The seller received the real agreed-upon price, $490,000 in the example transaction. The difference between the inflated loan amount and the real purchase price, that $135,000 gap, was dispersed at closing to an entity controlled by Gonzalez. On the settlement statement, that disbursement was labeled as an assignment of contract fee. It looked, to anyone scanning the document quickly, like a routine real estate fee. It was not. It was the laundered proceeds of the fraud, flowing directly from the lender's wired funds into Gonzalez's pocket, with the closing agent acting as an unwitting transfer point. Westergom's cut was smaller, but consistent. On that single transaction, property associates collected a $12,250 brokerage commission. Jack's Appraisals collected a $550 appraisal fee. Across the full life of the scheme, those commissions and fees added up to approximately $100,000 in his pocket. It was not life-changing money. It was steady, deniable, paper-clean professional income. To pad the loan files when underwriters asked for more documentation, Gonzalez submitted altered bank account statements showing balances that did not exist. He fabricated payroll records. He invented employment histories. Westergom did not need to touch those documents. His job ended at the signature on the appraisal report. The two men ran the same play, on the same template, 55 times across a period of roughly 2 years. 55 inflated appraisals. 55 loan packages cleared. $29,272,000 in first and second mortgages extended by lenders, including federally insured banks, on properties that were never actually worth the amount on the paper. The Florida real estate boom did not end gently. By the spring of 2008, median home prices in Duval County had begun to slide. By the fall, they were falling fast. Houses Gonzalez had purchased at the inflated paper price were now worth less even than the original honest price. Mortgage payments on the inflated loans stopped arriving at the servicers. The properties moved into default. The lenders moved them into foreclosure. And at that point, for the first time, somebody had to actually look at the files. Foreclosure attorneys reviewing the failed loans began noticing patterns. The same appraisal firm appearing again and again on properties owned by entities tied back to a single individual. The same buyer's agent on the purchase side. Appraisal values that, in hindsight, were wildly out of line with what comparable houses on the same streets had actually sold for. Six-figure assignment of contract fee, line items on closing statements that no one could quite explain. Cross-referenced loan files showing nearly identical bank statement letterhead with slightly different account balances. The Middle District of Florida U.S. Attorney's Office had been receiving mortgage fraud referrals for years by this point. Most had been handled through civil channels. But by late 2008, the volume had become impossible to ignore. In January of 2009, the U.S. Attorney's Office and the FBI's Tampa and Jacksonville divisions formally launched what they called the Mortgage Fraud Surge. Every criminal division assistant United States attorney in several offices was assigned to handle mortgage fraud investigations. Additional FBI agents were pulled in from other case categories. The scope was enormous. Prosecutors would eventually charge more than 100 defendants across the district, covering more than 700 properties and roughly $400 million in fraudulently procured loans. The Westergom and Gonzalez files surfaced inside that surge. FBI agents pulling appraisal records discovered that the same licensed appraiser was associated with 55 separate residential transactions involving the same buyer. They pulled the original purchase contracts. They pulled the loan applications. They pulled the closing statements. They lined them up side by side. On one transaction after another, the same pattern emerged. The contract price the seller had actually received. The inflated price reported to the lender. The matching inflated appraisal signed by Barry Westergom. The assignment of contract fee disbursement to a Gonzalez entity that exactly equaled the gap. The single transaction in Southside Jacksonville, the one where Westergom had negotiated $490,000 with the seller, then appraised the same house at $625,000 for his own client, became the prosecutor's clean example. One man, two hats, one closing table, two checks clearing simultaneously. There was no plausible deniability available. He had set the real price himself. We're heading into the federal investigation phase now. Before we do, if you've made it this far and you want to see more cases like this one, white-collar fraud that hides behind a professional license, subscribe and hit the notification bell. We covered the cases that don't get the cable news treatment. They deserve to be told properly. The FBI's approach to the Westergom file was methodical. Agents from the Jacksonville division spent most of 2009 building the documentary case. They obtained subpoenas for the complete records of Jack's appraisals and property associates. They served those subpoenas on a quiet morning in March at the Beach Boulevard office, with 2 agents in the lobby and a forensic accountant supervising the loading of file boxes into a federal vehicle. They pulled bank records for every account either business had held going back 5 years. They pulled Westergom's personal tax returns. They pulled phone records, email exports, calendar entries, and the metadata embedded in every digital appraisal file the firm had ever submitted. The metadata was where the case tightened. Modern appraisal software stamps each report with a creation date, a revision history, and a chain of custody for every figure entered. Agents could see, on file after file, that the comparable sales had been selected within minutes of the loan application figure being communicated. They could see Westergom's edits to square footage adjustments, made on revision after revision, each one nudging the final value upward toward the target. They could see deletions of more accurate nearby comparables. The files told the story of a man working backwards from a predetermined number, not forward from honest market evidence. Agents interviewed 3 former Jack's Appraisals employees. None had participated in the fraud. None had been told the full picture. But all 3, in separate interviews, described the same uneasy pattern they had observed. Files on Gonzalez-related transactions were handled exclusively by Westergom personally. He did not delegate them. He did not allow staff appraisers to review them. He kept those folders in his own office, in his own locked cabinet. One former employee told agents she had once asked him casually about a comparable selection on a Mandarin file, and was told, in a tone she described as unusual for him, to leave that file alone. The financial trail closed the case. Agents reconstructed the flow of funds on each of the 55 transactions. The settlement statements lined up perfectly with the bank records. Wire transfers from the closing agents to Gonzalez-controlled entities corresponded, dollar for dollar, with the gap between honest price and inflated appraisal. The total reached $6,296,303.65 flowing to Gonzalez. Approximately $100,000 flowing to Westergom personally through his commissions and fees. The lenders, taken together, had extended over $29 million on properties that were never worth that. Assistant United States Attorney Arnold B. Korsmeyer, working under U.S. Attorney A. Brian Albritton's office in the Middle District of Florida, took the case to a federal grand jury in the summer of 2009. The indictment came down quickly. The charge was conspiracy to commit wire fraud and bank fraud under Title 18, United States Code, Section 1349. The statutory maximum was 30 years in federal prison and a $1 million fine. The morning the agents came to Beach Boulevard, Barry Westergom was at his desk. It was a Thursday in early autumn 2009. He had arrived at 6:30, as he always did. He had his thermos. He had a manila folder open in front of him with a routine residential appraisal in progress on a property in Avondale. 2 agents from the Jacksonville division of the FBI walked into the suite at approximately 9:15 in the morning, with a federal indictment in one hand and a target letter in the other. The agents asked Westergaard if he was willing to speak with them. He said he wanted to call his attorney. The senior agent nodded, sat down in the client chair across from his desk, and waited. The receptionist later told a colleague that she could hear, faintly, through the door, the sound of Westergaard's voice on the phone, measured at first, then quieter, then nearly inaudible. When his attorney arrived 20 minutes later, the conversation in the office was brief. Agent, Mr. Westergaard, we have a federal grand jury indictment charging you and Mr. Gonzalez with conspiracy to commit wire fraud and bank fraud. We're not here to question you today. Your attorney has the document. We'd like to discuss surrender arrangements. Westergaard, I understand. Attorney, my client will surrender voluntarily. There's no need for anything further this morning. Agent, we appreciate that, counselor. There will also be a separate document production request served today on Jack's Appraisals and Property Associates. Westergaard, I understand. He signed the receipt for the documents. He walked the agents to the lobby. He returned to his office, closed the door, and according to the receptionist, sat at his desk for nearly 2 hours without making a phone call. By the end of the day, his attorney had reached out to AUSA Korsmeyer. By the following week, plea negotiations had begun in earnest. Westergaard never returned to his office in the same role again. The Property Associates phone line was eventually disconnected. The Jack's Appraisals website went dark. The Beach Boulevard suite was vacated within 90 days. He did not deny the conduct to investigators. He did not blame Gonzalez. He did not invoke any defense beyond what his attorney would later argue at sentencing. That he had been swept up in the boom. That he had been a small player relative to his co-defendant. That he had personally received only a fraction of the proceeds. His statement to the agents that morning had been 4 words long. I want my lawyer. After that, every word came through counsel. Barry C. Westergaard pleaded guilty on October the 8th, 2009. The plea agreement laid out the entire scheme in clinical, paragraph-by-paragraph detail. 55 properties, $29,272,000 in fraudulent mortgage lending, $100,000 in personal proceeds. He acknowledged the conspiracy with Gonzalez. He acknowledged the inflated appraisals. He acknowledged the use of inappropriate comparables. He acknowledged that he had served simultaneously as the buyer's agent and the independent appraiser on transactions in which both functions were supposed to be performed by separate, unrelated parties. He acknowledged that the lenders, including federally insured banks, had relied on his signed certifications and had been defrauded. Juan Carlos Gonzalez pleaded guilty to a parallel conspiracy charge. On November the 5th, 2009, Gonzalez was sentenced by the same court to 7 years in federal prison. Westergaard's sentencing was set for February of 2010 in the courtroom of United States District Judge Henry Lee Adams, Jr. The defense submitted a sentencing memorandum that ran more than 30 pages, attaching letters of support from Linda, from his 2 adult children, from the youth baseball families he had coached 2 decades earlier, from neighbors in San Marco, from a former pastor at the family's church. They described a man who had paid his taxes, raised his children, mowed his own lawn, and made one catastrophic professional choice during a period of market mania. They asked for leniency. The government's sentencing memorandum took a different view. AUSA Korsmeyer argued that the conduct was not an isolated lapse, but a sustained pattern of professional betrayal carried out over years across more than 4 dozen transactions in deliberate violation of the duties of independence that defined his licensure. The government pointed to the smoking gun transaction, the $490,000 negotiation, followed by the $625,000 appraisal, as proof that there had been no confusion, no mistake of judgment, no mere overvaluation. He had set the real price himself. He had then certified, under penalty of federal law, a price he knew to be $135,000 higher than reality. Judge Adams sentenced Barry Westergaard to 4 years in federal prison. He ordered restitution in the amount of $866,141.62. He entered a separate money judgment of $100,000, representing the full amount Westergom had personally received through his commissions and fees. In delivering the sentence, Judge Adams addressed the courtroom directly. He noted that the appraiser stands at a unique point in the residential mortgage system. He observed that the entire architecture of federal mortgage regulation assumes that the appraiser is independent, impartial, and willing to deliver a number that is honest, even when the parties to the transaction would prefer otherwise. He stated that when an appraiser abandons that independence, the harm reaches not only the immediate lender on a single transaction, but every borrower whose own future appraisal will be measured against the inflated comparable, every neighbor whose property values are distorted by the false data, and the basic integrity of the housing finance system itself. He said the 4-year sentence reflected both the seriousness of that betrayal and the defendant's acceptance of responsibility through his guilty plea. Westergom self-surrendered to the Bureau of Prisons in the spring of 2010. He served his sentence at a low-security federal facility within the Bureau's southeast region. He was released in 2013. His Florida appraiser license had been permanently revoked by the state's Department of Business and Professional Regulation as a collateral consequence of the conviction. The Beach Boulevard office was, by then, occupied by a different small business. The Property Associates corporate entity had been administratively dissolved by the state. Jack's Appraisals had been dissolved. The Middle District's mortgage fraud surge would continue producing convictions for several more years. By the time the prosecutorial effort had run its course, more than 100 defendants had been charged. More than 700 properties had been documented as involved in fraudulent transactions, and more than $400 million in fraudulently procured loans had been identified by federal prosecutors. The Westergom case was one file among many. It was also, in the words of the prosecutors who handled it, one of the cleanest illustrations the office ever had of how the residential appraisal system was supposed to work, and how completely one licensed professional could break it from the inside. This case was a quiet kind of devastation, but the case on the right-hand side of your screen is a different category of betrayal entirely. Click it now.